So, there are two journal entries. There are two journal entries. One journal entry is needed to record the sale. Second journal entry is needed to record the cost of goods sold. So what you would see is the first entry would debit accounts receivable and credit sales revenue. Whatever the number may be. And then the second entry is going to debit the cost of goods sold and credit the merchandise inventory. So the way to think about this is just think about buying something in a department store, going up to the cash register, somebody scans it in, swipes your credit card, and obviously they're going to record the sale. Your account is charged. By the way, debit is also synonymous with charged. So we charge your account, we debit your account, and sales are recorded. At the same time, the merchandise, if the accounting system is properly structured, the merchandise comes out of inventory and we can record the cost of goods sold at that time as well. So the stock is removed, so the next customer that comes in is not going to find that merchandise in stock. So if you ask for that merchandise, they check, their computers would show the merchandise is gone. So those are the two entries you have to make to record a sale on a perpetual inventory system. So that means, I'm not going to ask you this question, but if you go to number 3, the answer is C. So that entry, if you have selling merchandise with a cost of $221 for $350 on account, and the seller uses perpetual inventory, then the correct answer would be to record part of, not the whole sale, but part of the sale would involve a debit to cost of goods sold, and of course a credit to the merchandise inventory, and it's for the cost. The good thing about this question, and going over the exam, we had about 30 some odd people here on Wednesday, and I had a few people in my office. It seems that when you're making the choices, you got to be very careful because you might see the right or the correct number, but you're not picking up the correct accounts, or you have the correct number, but you're picking up the wrong accounts. So in this case, 350 is definitely wrong with respect to those first two entries because they involve cash. I mean, obviously A and B have to be wrong because there's no cash, it's on account. And then with the second one, with D rather, that would be incorrect because what that's doing is increasing inventory and reducing cost of goods sold, which doesn't make any sense if you just sold something. So the correct answer would have to be C. All right, so again, that would be a question that corresponds with your first answer. All right, next, let's try this one. I want to know the normal balances, and these are in order. So the question is, what is the normal balance of sales, sales discounts, and sales returns and allowances? Okay, again, we're just reviewing from Tuesday before we start anything new. So sales discounts, and sales returns and allowances. All right, well, this one's kind of split again, and sales has, let's go over here and look at the answer first. Sales has a normal balance of a credit. So anybody that put A and B, please go back and review the normal balances. Sales has a normal balance of a credit. Then sales returns and allowances and sales discounts are both debits. They're contra revenue accounts. So the correct answer here is going to be C. So they're both contra revenue accounts. Sales, returns, and allowances and sales discounts are contra revenue accounts. They reduce revenue. We record them separately, and I asked the question, and just to make sure everyone heard the question, again, I asked the question, why do you record sales, returns, and allowances separately? And you answered the question by saying that you want to keep track. Obviously, if you're running a business, you want to keep track of how many products come back, how many products come back damaged, defective, or how many allowances do you have to give? Because what does it mean? Maybe the shipping company you're using is not being careful with the merchandise, and the goods come damaged or scratched or not up to specifications. So you want to keep track of sales returns and allowances and sales discounts. So we keep those separate. All right, one more, and then we'll get into the next learning objective or next part of the module. Actually, two more. Let's do this one. I may do the next one. I want you to calculate, and we're going to do more with this question as well. I'm going to go on and add a few more things. I want you to calculate net sales revenue, and it shouldn't take you more than a minute. Net sales. So we have sales revenue, cost of goods sold, operating expenses, sales discounts, sales returns and allowances, and then we have interest revenue. All right. All right. It is 425. 425. Now, when I was going through the exam review, showing everybody that I actually worked these out myself, so this is what it would look like. It's sales minus sales returns and allowances and sales discounts. Okay, so again, I always go through them, making sure that the author is correct, and those are your net sales. Now, I could also extend this question, and I want to know what's my gross profit. How would I get gross profit here, Ian? Right, net sales minus the cost of goods sold. So you come down, and then you have gross profit of 125, and then to get net income, and by the way, you notice here, move this over a little bit, I've got something known as a gross profit margin, and that's one of the last learning objectives. I mean, there's nothing in there except this ratio. The gross profit margin says that if sales are treated as 100%, cost of goods sold is about 71% of sales. So if you take the cost of goods sold of $300,000 and divide that by net sales, you've got a 71% cost of goods sold, and your margin is 29%. It's 125, and I'll repeat this again, 125 divided by the 425. Now, why do I get that in percentage terms? Because I want to keep track over time of my profit margin. Because you have to remember, gross profit is defined as the amount of sales dollars that remain to cover operating expenses. So if your gross profit is declining, that means you have less and less dollars to cover operating expenses. So if a company is starting to face losses and they can't cut operating expenses, what would they have to do? Either raise their selling price or try to reduce their cost of sales, buy cheaper merchandise. And a lot of you may know that Walmart, and there are a lot of good documentaries and case studies about Walmart, they have a very strong, I guess, influence on their suppliers to make sure their profit margins are maintained and they can continue to keep their prices low. They keep their prices low by getting their suppliers sort of almost like captive and telling them, look, you want to do business with us, you've got to sell it to us at this cost. We want to keep our costs low. And that's where that would come in. So the profit margin is gross profit divided by sales. Okay. Now, how would I get net income here? What's the only item that's left? You got your operating expenses. Subtract that out. And then, of course, that would be, and I've got interest, operating income, I should say. And then I've got my, this is operating, I should say, operating income. We're not going to, interest revenue does not, it's a non-operating item. So it's not net income, it's operating income. We're going to talk about that a little bit. Now let me go back to this. Is everyone clear on how to get the gross profit margin? It's 125, the gross profit divided by sales. Just want to make sure you're familiar with that calculation. Okay, we're going to spend a little bit more time on operating income and net income. That's not the net income. You still have interest revenue. Interest revenue is a non-operating item. All right, any questions on that? Yes. Yeah, the gross profit margin is simply if you took 125, which is the gross profit, and you divide it by sales. I'll move that up for you in a second. That's the gross profit margin, and that should be 29%. 71 is the cost of goods sold percentage, and that's COGS divided by sales. Hold on a second. It's got to add up to 100. Yep. Question? Yep, that's what it is. Yeah, it's cost of goods sold in a percentage term is called the margin, the profit margin. So these are statistics that we track very carefully over time to make sure that we're still selling profitably. By the way, if your gross profit starts to go down, what happens if you have a negative gross profit? You've got to shut down because you can't cover your operating expenses. Yeah. It's called the gross profit margin. Oh, this is called the cost of goods sold percentage. I'm sorry. Didn't hear that, thank you. The cost of sales percentage. This is the gross profit. Gross profit margin. All right, just statistics. This is in one of the learning objectives at the end. It's really only one page, so might as well hit it with this example. Any other questions on this particular question? Yep, Shirley? Sure. Okay. And this says operating income. That's operating income. Not net income, but we're going to explain the difference in a few minutes. Okay. Anything else? Question? I'm sorry? All right, hold on. Somebody wants it down, somebody wants it up, so. All right. There you go. All right. That'll get both. Okay. All right. In the meantime, any other questions? All right. Now, if you're looking, let me just get to this last question. I had a question today during office hours about the sales discount, and we'll do one question on that right now. Any other questions on this? Anyone else need more time, or everyone set? Okay. All right. Let me move on to your last question, then we're going to get to the next learning objective. All right. What I want to know is we have a jewelry company using a perpetual inventory system. On April 2nd, they sold goods with a cost of $5,500 for $8,000, terms of $310 net 30. On April 10th, they collect what would be the correct journal entry. So to answer this, I'm going to give you a little bit of a head start. You have to determine whether or not the company that's paying you qualifies for the discount. And how do they qualify for the discount here? How do they get the 3% discount? They got to pay within 15 days. So you have to determine that first, and if they do, then you have to calculate the discount. So give you, again, the usual minute on this, and then we'll move on. So, do they qualify for the discount? If they qualify for the discount, how much is the discount amount? And on top of that, what's the correct journal entry? What's the correct journal entry? And again, if you now think about the exam, I don't think these questions are much different from the way the exam questions were laid out. So this is not a bad, looking at these end of chapter questions is not a bad thing to do either. Okay. All right. Doesn't mean that the most frequent answer is correct, does it? Yeah, it is. Okay. All right, so that's the correct answer. And it's A. And okay, so first of all, the company paid you, okay, hold on, the company paid you within the discount period. The discount is 3% of $8,000, that's $240. So the question I had during office hours was just to be sure this individual understood, saying that, look, the entire amount of the accounts receivable is paid off, but you only gave me $77.60. The reason for it is that we allowed you to take 3% off the invoice or the balance that you owed. So that's the balance of accounts receivable. It was $8,000. We took the 3% off, and yep. Yeah, that would be if merchandise inventory is credited, that's for a return. Only if you, that would be for purchase discounts. That's the purchase side. Okay, for the purchase discount, what you're doing is you're technically valuing the inventory that's on your books. So if you return the inventory, or if you get an allowance on the inventory, that reduces the unit cost of that inventory, or the total cost of the inventory. So that's why you reduce it. We don't use separate contra accounts for, a lot of you, I just talking to somebody earlier, in high school, if you were studying, and there are some questions from the appendix, which we're not covering, which is the periodic system. Periodic system uses contra accounts, purchase returns and allowances, purchase discounts. The perpetual system doesn't do that. They flow everything on the purchase side through merchandise inventory. All right, that's it for this particular learning objective. Now, another quick learning objective, these will be pretty fast here. We want to look at the closing entries and adjustments. The only adjustments you typically find in inventory is when there are errors. So you could have the actual or the physical inventory that's counted at the end of the year does not necessarily equal the amount of inventory in the perpetual records, so that you have a certain amount in the perpetual records, you then count the inventory, there's a difference, inventory's got to be adjusted. The inventory adjustment could be due to waste, spoilage, theft, inventory errors, whatever it is there and it has to be adjusted. Now, if the errors are, or if the differences are systematic, it could be pilferage or theft within the company, and then you would have to obviously examine that, but that's the benefit of having perpetual records, and that's the benefit of having physical counts. And as I mentioned, you must take a physical count even if you have perpetual records. And any adjustments through the perpetual system would flow through the cost of goods sold. And to see how this works, let's take a very simple example. Your perpetual records tell you that you've got 50,000 in inventory. You take a physical count, you got 48,000, and there is a loss of 2,000. The loss or the error or the theft, the shrinkage, is accounted for in the following way. You would debit the cost of goods sold, and you would credit the merchandise inventory. The merchandise inventory is reduced for the $2,000 that will no longer be included because of either spoilage, theft, or damage. So that is your adjustment. And very simple, it's probably the only adjustment that you would have. From a closing side, this one is also pretty simple. And as I said, we're going to go through these pretty quickly. When you close through them, you know the closing entries. Oh, yeah, I'm sorry. That's okay. No, cost of goods sold, okay, yeah, I'm glad you asked that. Cost of goods sold is like an expense account. So when you close it out, it has a debit balance, so you close it out by a credit. You have to treat cost of goods sold like expenses. Yeah, you would definitely somewhere, I don't know if it would be in the journal, but somewhere in the company you would document the loss and then examine whether or not it was damage, whether or not it was, just an error or theft. If the items are missing a little too frequently, then you have to go and make more of an investigation. Okay. All right. Now, the closing entries, again, they're the same 4 closing entries, but if you look at the items that are in blue, these are the items that are unique to a merchandising company. You have sales revenue, the contra accounts, sales returns and allowances, sales discounts, cost of goods sold, and way on the bottom, the delivery expense or the freight out or the delivery expense. Now, these would be closed in the regular way. Sales revenue is going to be debited to close it. Sales returns and allowances, sales discounts, cost of goods sold, and delivery expense will be credited in the closing entry. And of course, and remember, the sales discounts and sales returns and allowances are contra revenue accounts, and they're all going to be closed out in the same way. So again, just like in the other chapter, if you look at the closing entries here, and again, not anything different from what we had, the closing entries will debit sales revenue, credit income summary. Then you would debit the income summary for the total of all of the expenses and cost of goods sold and sales returns and allowances and sales discounts. Expenses also include delivery. So now the new or the unique accounts that we have for a merchandising company include the contra revenue accounts of sales returns and allowances and sales discounts, along with the cost of goods sold and delivery expense. Cost of goods sold should be treated like any other expense. It is, I think, an important area, as we said, because it's not like an operating expense that is easy for you to control. So for example, here in advertising, that's really up to you, correct? I mean, if you're not doing very well, I know it sounds kind of silly to say, well, I'm losing business, but best thing to do, I can cut advertising. I might, obviously be cutting sales a little bit more, but that's something that is more discretionary. I have to pay salaries. I have to pay insurance. I have to pay utilities. Advertising is something I have a little bit more choice over. I can't really cut my cost of goods sold unless I buy less merchandise. And if I buy less merchandise, I could be losing sales even more than by cutting advertising. So again, it is like an expense, but it is more important than most expenses because it drives the profit margin. Okay, and then of course, after you have your post-closing, your adjusted trial balance, and then of course, income summary is closed out to retained earnings, and dividends are closed out to retained earnings. Just to remind you, in this case, income summary has a credit balance, meaning that there is net income, and of course, we close that to retained earnings by debiting income summary, crediting retained earnings, and the dividends are closed out by a debit to retained earnings and a credit to dividends. So nothing different, nothing unusual from what we've been doing, except that we now have those unique merchandising accounts. Now, when we looked at the merchandising company so far, from the standpoint of the financial statements, we're not really working on cash flow anymore. We'll pick that up a bit later toward the end of the semester. The 2 statements that we are concerned with, really 3, but the 2 primary statements are balance sheet and income statement. And we said that the merchandiser has a unique balance sheet. What was unique about the balance sheet? The fact that merchandise inventory was probably one of its most significant current assets, and we also said that accounts payable would also be material or significant to a merchandiser because of its purchases of inventory that we assume that are on accounts payable. Just like there are unique features to a merchandiser's balance sheet, there are unique features to its income statement. When you look at the income statement for this will be one of the last learning objectives we'll be covering. The income statement could be in two forms. One is called, or two formats. One is called a single step, and the other is called a multi-step. Multi-step is the most popular because it provides the most relevant information for decision making. When you have a single step statement, it is pretty much exactly what you think it is. It just combines all revenues and all expenses, taking the total revenues and subtracting from that in one step all of the expenses. So to see what that looks like, you just basically, and you don't get much information, so you just take your net sales revenue and then just subtract all of the expenses, and then you've got your net income. So again, in a single step, you take all revenues and then subtract total expenses. Now, what's wrong with that? You're going to say you still get net income. What do I care about the subcategories? Well, you have to remember, when you look through here, you've got a couple of problems because you're combining selling and administrative, and you're also combining operating, and that's why I mentioned that was operating income. You're combining operating income with non-operating income items. Very beginning of the semester, if you remember, I talked about non-operating or peripheral types of income. Gains and losses are also part of non-operating. So as I said, a Dell computer sells a building and has a gain. That's not part of its normal operations. So this is very difficult for a user to strip out what's operating and what's non-operating. So although net income is there, you got the right answer, it doesn't provide you with as much relevant information. So because of that, we now see that, again, that's the explanation on the next slide, that we don't provide you with really relevant information. We don't give you key subtotals. By the way, you don't even see on this single step, you don't even see the gross profit. I mean, obviously you could get it. It's not that hard to calculate, but it's not there. It's not as transparent for the user. So what we do is we focus pretty much in practice on a multi-step. And in a multi-step, you have lots of steps, but the two key steps are to come up with these subtotals. Cost of goods sold is subtracted to come up with the gross profit. And as I said, gross profit is a critical measure for a business to keep track of its success or potential failure if you think about gross profit margins over time, and operating expenses are then deducted. We then have this non-operating section where non-operating revenues, for example, interest revenue or gains, are only secondary to the business. And losses and expenses like interest expense are also secondary. Now, what's the difference, again, between a gain and a revenue? Right. So again, just to repeat that, we said that way back, that gains are part of your normal operation. Revenues are part of your normal operations. Gains are from outs or activities outside of what you normally do. So if you find accounting, not relevant, well, think about a day-to-day event. What if you were applying for an auto loan or student loans or whatever you need money for? They would be looking at your salary. They wouldn't be looking at the fact that you just sold your car and you earned, or you had a gain of $1,000 on a sale of a car. That's not going to happen every year. That's not recurring income. If you had interest on a savings account, that may also be non-recurring. So what we look at to assess your ability to pay back your loan is your normal recurring income. It's exactly the same for a corporation. So what we're trying to do is ensure that the reader of the financial statement has the ability to identify what is normal recurring income that they could rely on if they lend money or if they invest in your company. So these peripheral activities will add or enhance to the company's income, or maybe take away from it if it's a loss, but it's not something that you could expect to see on a regular basis. We also will separate out other non-operating items as we said. And we also now look at different functions of expenses. We have selling expenses and administrative expenses. And this is important because we want to see, for example, if administrative expenses, let's put those off to the side for a minute, but what we would want to see, if selling expenses are increasing with sales, would you expect that to be the case? I think so. Yeah, sales salaries, sales commissions would go up if your sales go up. So you want to look for relationships. Administrative expenses would be, the vice president's salary or a person that works in the warehouse, the foreman of the warehouse. That person's salary would be fixed and unrelated to sales. Yeah, utilities would be an administrative expense. But if you think about charges for travel or gasoline and maybe maintenance on vehicles that you use for your sales force, then that moves to selling. You could also, from a selling expense perspective, if you have a separate sales office, then the utilities on the sales office could be separated. So next semester when you do management accounting, we do a lot more of the separation. We would say what costs are involved with the factory, what costs are involved with the administrative offices, what costs are involved with overall, this overall sales function versus the administrative function. And production, because you have something else. Next semester, you don't worry about a merchandiser, you worry about someone that produces. So you would have cost of manufacturing, cost of selling, and administrative. And those would have to be broken out separately as well. All right, so let's now we're going to build a multi-step statement. The first key subtotal in a multi-step income statement is, as we've been saying, the gross profit. So it's sales minus the contra accounts, minus sales returns and allowances, sales discounts, to get net sales revenue, and then, of course, minus the cost of goods sold would give you the gross profit. Next, same statement. We then break out the expenses by selling and administrative expenses. And we're able to, again, I would look at my selling expenses and take a look at those. You got rent on an office, right? Because rent could be administrative as well. So rent on a corporate headquarters could be administrative, but rent in a sales office will be a selling expense. So we break those out separately. So I would want to see, for instance, if my selling expenses are moving with my sales. Are they moving in the same proportion or the same direction? And administrative expenses could be something that I may be able to cut back on without harming the sales. So selling expenses, if they contribute to increased sales, I don't mind putting money into selling expenses or advertising. Whereas administrative, there may be ways I could cut back. There may be some salaries in the administration that I could cut back, and technically that might be the first place you'd be looking to cut. Now, operating income. Operating income is an extremely important measure because it is what you would expect the company to earn on a day-to-day basis. Now, if you look at this statement, we also see operating income, and this is not always true on all financial statements, but in finance and in management. Operating income is sometimes called earnings. Earnings before interest and taxes. So you see this term EBIT, that's earnings before interest and taxes. So operating income is sometimes called earnings before interest and taxes. And once again, I want to know what you earn outside of interest income or interest expense. So for instance, if you take, let's just say we look at our Rutgers success in placing students. We want to see what students are earning when they're placed. We don't consider whether or not those students have money in the bank and have interest income or had student loans and now have interest expense. We're primarily concerned with the salaries that are generated from the degree. And in that sense, it's very similar to what we do in corporations. We want to look at corporate earnings before any interest income or interest expense and any taxes. And that's what operating income is. So operating income is also called EBIT. Yeah, Brianna? Well, yeah, because we do look, okay, so I think I'll address the question this way. We don't really stop here. We go further to look at other sources of income. But if I'm making a projection, if I wanted to project what this company was worth, so now we got, who's going up, Twitter? They're thinking about going public and selling their stock. If I look at that company's financial statements, I'm not going to look at whether or not they've got interest revenue on some investments that they could sell tomorrow. I want to see what income they generate from advertising or however they make their revenue. So I want to see their recurring, and that's where the value really lies. The value of a company lies in its ability to generate income in the long haul. Right? So if I'm going to buy the stock, if I was going to buy it and sell it tomorrow, then maybe I'd look at some short-term gain or unusual gain that they had, but I'm looking long-term and I need to use this information to make projections. Remember we said earlier that in the semester that we're looking at financial statements as a way to have a reasonably informed user make decisions with respect to credit or investments. Yeah, Matt? What was that on? Say that on Yahoo.
So on Yahoo Finance, if you go to an income statement, you see revenues that are right below you, just cost of goods sold, sales discounts, and
So they're just showing you the gross profit. Right. Yeah, they're giving you partial information. I think if you needed more information, you should look for the company's financials, which you could get. Almost every company has their or if they're publicly traded, you should be able to get a full set of financials. Right? So that's just partial information. You got to be careful when you look at published sources of information because they're not always complete. So if that's all you're getting, you're only getting up to the gross profit. Right? Okay. All right, now, let's make sure we understand why EBIT is going to be an important measure. I'll do that. Now, by the way, of course, once you then subtract out interest expense, then you would get your net income. Net income is after all of the other revenues and expenses. Now, just make sure you understand at least the same, or at least the primary things we just said, why EBIT is considered a key measure, or operating income. It reflects the core operations of the business, so that's number one. That's the primary or the normal operations of the business. The users of financial statements can compare firms regardless of their capital structure. In other words, regardless of whether they borrow or whether they issue stock to get their dollars or to get their financing. Because remember, so far, how did companies get capital? How did they get cash to buy assets? They either had investments of stock or they had accounts payable or notes payable or debt. So this will tell you the income that's generated regardless of the way the company's financed. And as I said before, I want to look at everybody's salary after they graduate, and I'm concerned with that salary level, and I don't care if somebody has a student loan and somebody doesn't, because if somebody has a student loan, they finance using debt. If someone paid their own tuition, they finance using what? Equity, or like their investment. They made an investment on their own. So I don't really care how, eventually we'll get to that, because it's a real good point, because eventually we have to look at the debt levels of companies, or we'd have to look at the debt levels of individuals. But right now we're concerned with the company's earnings outside of the way it's financed. And the other way to look at EBIT, that's the cash available now, so that's why your question was right on point, because that's the cash or the income that's available to now pay off debt, to pay dividends to stockholders, and to pay the government through taxation. Because you have to remember, you have three stakeholders in a business. You've got stockholders, you've got debt holders, people that lend money, and then of course there's the government. Government provides you with infrastructure, and you pay those taxes to pay for that infrastructure. So those are the three primary reasons why we look at operating income, or EBIT, as a key measure of financial performance. And we'll get back to that throughout the semester. All right, and finally, this is a summary for you to just understand the differences between the multi-step and single-step statement, and also defines other ways to understand, or other types of other gains and other expenses. So for example, other revenues include interest revenue, dividend revenue, rent revenue if you sublease a store, gain from selling property. Other expenses would include interest expense, casualty losses, insurance losses, losses from sale of property, plant, and equipment, and losses from employee strikes. If employees walk off the job, how much did you lose, or how much was incurred for those strikes? So again, you can read that. It'll be obviously clear if you had the slide printed, but if you don't have it with you, that'll be something that you can print out. All right, so just a couple of things. Number one here, and I'll take some questions in a second. I'll answer some of these questions for you, and one I'm going to ask you to try on your own. First one is, of course, true, and this is true for both the multi-step, single-step income statement and the report form and the account form of the balance sheet. You get the same results, right? So now when you go back and think about the formats of the balance sheet, the two formats of the balance sheet are report form and account form, and the formats for the income statement are going to be the multi-step and single-step. You got to get the same answer. So the answer is A, or it is true in this case. Okay, the next one tells you that on a multi-step income statement, both merchandisers and service companies will report operating expenses in two categories: selling and administrative expenses. And what do you think for service companies? And this one, the reason why I didn't ask this is it's kind of a, I wouldn't say tricky, but it's could go either way, but technically I would think that a service company would probably have mostly administrative expenses, right? Service company probably has administrative. They do have sales, but when we think of service here, we're thinking about a computer, software company that generates or that develops software, or a lawyer or a CPA. You do some advertising. There are some selling expenses, but for the most part, they would be administrative. So this one, as I said, could go either way, but the answer is probably false, because the merchandiser is going to have a lot more selling expenses because they're actually selling a physical product. All right, and finally, before I ask a question for you to do, this one says expenses that fall outside of the regular operations, and the answer is C. You should know that anything outside normal operations, outside the core, non-operating items are in other revenues and expenses. All right, so now I want you to calculate the company's operating income. So I want you to look at the company and its sales, cost of goods sold, interest revenue, operating expenses, sales discounts, sales returns and allowances, and we're looking at operating income. Let's get the operating income, and then I'll ask you some other questions regarding the net income. right. And that was that's a tall one too, right? All right, yep. All right. Yeah, so the answer is A, so that's good. All right. So, all right, so I'm going to show you, again, we'll just use the document cam here. We'll come in a little bit. Yes, I'm sorry. Thank you. All right, so let's go right here. Now let's start with the answers. So you should have got sales, minus the sales returns and allowances. Minus the sales discounts. Would give you, of course, net sales. Then you have your gross profit coming from subtracting the cost of goods sold. Gross profit's 55, operating expenses 42.5, and that's your operating income. Now that is, in fact, in this case, EBIT. It's earnings before interest and taxes. It's earnings before interest and taxes. And then, if I then add the interest revenue, I get the net income of 22.5. So 22.5 is B, but that is only true if you're looking for net income, not operating income. So for those of you, and these are mistakes that I've seen on the exam, where you just read something quickly. I know you might be running out of time. That's understandable sometimes. But the net income is 22.5. All right. So are there any questions on Chapter 5? Any questions on 5? We're not going to do the next learning objective because that's the gross profit margin. And the appendix is the periodic inventory system. You might have a couple of, maybe one question on the homework or two on that. So, but we're not going to cover it here. That's for your own review. Any questions on Chapter 5? I'll talk about the quiz in just a second. Yes? Slow it down, please. I can't hear the question. Yeah. What do you mean by double? All right, let me see back on this. You're talking about right here on this problem itself? Okay. Oh, in the book, in the textbook? Okay, I'd have to see that. Yeah, we'll have to do that. We'll do when we're, yep. Question? It's not operating. Yeah, the question is, interest revenue is not added because it is a non-operating item. Okay, so interest revenue is not added because it's a non-operating item. Okay, now, when we're going to start on Chapter 6 right now, but the quiz itself, it only goes up to 5. So again, just to be sure, and I want to talk a little bit about administrative things just for a second. All right, one or two things just keep coming up when people are coming to the office. One, got to use Blackboard. You got to go on there. There could be announcements. You should be getting emails. If you don't get them, let me know. If someone else gets it and you don't, let me know. Check Blackboard for the clicker grade. Sometimes the grade falls off. It goes into an unidentified clicker. If you give me the clicker number, I could find it, and we have to find out why it doesn't get registered properly. The other thing is My Accounting Lab. On the opening page, it tells you when your next assignment is due, and if you click on your assignments, you'll see when all of your assignments are due. So use the technology, and you'll be able to keep up with everything. There is the homework's due Sunday, of course, midnight. That's for Chapter 5. And the quiz for 5, only Chapter 5, is going to be due on Tuesday. Okay. All right. So whatever we cover today in 6 is not on the quiz. The quiz will become available in 2 hours. At 4 o'clock, you should have access to the quiz. Chapter 5 only. All right. All right, so now, we're going to now get into the actual valuation of merchandise inventory. Tom, a question, I guess, on Tuesday regarding the unit cost of inventory. So far we've been thinking about inventory in the aggregate, so only the total inventory. Now we're going to look at the components. We're going to look, as I said before, we think about inventory in terms of units and unit cost. Question that was raised was, well, doesn't the freight in and doesn't the sales purchase returns and allowances impact the unit cost? It does, and we'll see that, although we won't see it directly, but we will see the unit cost. Before we do that, however, we're going to get back into the concepts. And another, I guess, observation from the exam is that a lot of people had more trouble with the concepts than they did with the mechanics. The concepts are just as important, so you have to make sure that you understand them, because a lot of the questions were application questions. So you might say, oh yeah, business entity or economic entity means I just have to keep the owner separate from the business. But then when we had a question that talked about someone's personal property that had a fair value of $425 and a market value of $575, you automatically thought about historical cost as being the most relevant concept. The most relevant concept there was the economic entity concept. So make sure you read those, and we're now going to get into a few more. Every chapter, every once in a while, we'll bring in the concepts. So the first concept that relates to inventory, and the reason why it relates to inventory, because in this chapter, we're going to start to introduce accounting alternatives, different ways to value inventory. Some of you might have seen this before on a high school course. You have last in, first out, average cost. So you do have different ways to value inventory. We're going to look at this on a perpetual basis only. We're not going to do the periodic, although that is, again, in the appendix. So when you have an accounting method, you really should use that method every year consistently, unless there is a justification to change it. So if I'm using one measurement system, and this is something I said early on in the semester, that you're really measuring the same economic event differently, just like distance. As I said, if you watch a baseball game in Toronto, it's got 91 meters. Yankee Stadium is 300-something feet. So it's the same distance pretty much, but it's measured using a different measurement system. So if we change one accounting method, we violate consistency. Now, it doesn't mean you can't change, but you have to be able to provide enough information to explain that change and to restore comparability. So what we're really looking at here is, if you think about you look at this concept of consistency, and what that will do is lead to comparability. So if I apply a method on a consistent basis year after year, it enables me to compare the firm over time. And it also enables me, when we look at disclosures, we'll talk about full disclosure next, it also allows me to compare one company to the other. So for instance, what if, again, you have a company that measures distance, just hypothetically, because you may not have seen accounting methods yet. So, or let's just go to something you probably just saw, the financial statements in a single step versus a multi-step. What if a company always used single-step statements, and now this year they switched to a multi-step? It's not easy to compare. Different line items, the numbers look different. So as long as I'm using the same approach, the same method, period after period, it is consistent, and that allows for comparability. I can compare the company year after year. I could also compare this company to another company in the industry using the same method. If the statements look different, there are footnotes that will tell me what method the companies are using. So I'll be able to at least get an idea. For example, if I look at the distance issue again, and I look at the 91 and I look at the 313, I'll say, well, wait a minute. Well, now I know. If one is in meters, I understand that system. And if one is in feet, I also understand that system as well. So I can compare them and maybe actually convert them. So consistency means that you use the same accounting methods period after period unless it could be justified. You may need to make a change, and you can make changes. If you change a method, it violates consistency, but it's allowed with full disclosure. And that will restore comparability. So consistency means, again, we want to use the same method period after period. We want to use the same method period after period in order to be able to compare companies over time and to be able to compare companies in the industry. If we change our method, it violates consistency. However, changes are allowed as long as there's enough disclosure to restore the comparability. So, for example, I'm using a certain method, and under that method, my net income is always $1,000 per year. I change my method, and now my net income goes to $2,000. I would have to tell the readers of the financial statements that my net income doubled, not because of anything from an economic standpoint, not due to anything I did to change my business, but because I changed my measurement system. So once you make the change, it violates consistency, but it is permitted as long as there is enough disclosure to enable a reasonably informed user to restore the comparability. So if we go back to material, if the company does change their methods, they have to communicate it to stockholders, and they have to do that through footnotes. And that footnote has to include information about the change. What's the change all about? What did I do? What method did I change? And how that change affected net income. So I have to describe the nature of the change, the justification, and the effect on net income. And that has to be communicated through the footnotes in the financial statements. And again, that will, here, it's summarized here, it allows you to compare. So consistency helps compare, and so do the disclosures if there are changes. Now, this is all part and parcel of what we call the full disclosure principle, or the disclosure principle, which I think I've pretty much described already. So to summarize, consistency has to be followed. If you violate it, it's accepted as long as there is enough disclosure to enable a reasonably informed user to understand the differences and compare it. Footnotes, right. The footnote would say, I changed my method of accounting to X, and that method now has doubled my net income. So nothing changed economically, it just changed my method. Also, if you study finance and management and accounting enough, you'll know that certain methods, and we mentioned this in the first week, and that first week was designed to provide you with a little bit of a background that we always get into the details. Some methods increase income, other methods reduce income. So if you see the footnotes, they'll say, okay, I'm using this method. That method tends to report higher income, and I'm comparing this to a company that uses another method that tends to show lower income. I understand that there's bias in those numbers because of the method selected. So this is some of the things you'll pick up down the road with respect to the accounting methods. And again, as I said, that's that full disclosure principle that we talked about, that you must provide enough information so that a reasonably informed user can make rational economic decisions. Now, an example of a disclosure, and this came from the author, I don't know why why they cut off the last sentence there, but here's an example. I said in this chapter, we're going to talk about inventory valuation methods. First in, first out is one of the methods that we can use to value inventory. They describe the inventory. This is not, by the way, this is not a change in method. This is just a straight disclosure. If inventories are disclosed, you'd see something like this. Inventories consist of green and roasted coffee, including coffee in portion packets, purchased finished goods such as coffee brewers and packaging materials. Inventory stated at what is known as a lower of cost or market. So inventory is stated at the lower of its original cost or its market value. That means if its market value collapses, the inventory is reduced because it's lost some value. And that's being, as we'll see, conservative. And it's measured by using an adjusted standard cost, which you'll see next semester. But what we'll see in this chapter is the first in, first out approach. Okay, so if there was a change in inventory valuation, the company would say that we changed our method of accounting for inventory, and that change had the result or had the impact on income to either raise net income or lower net income by a certain amount. All right, any questions on consistency, comparability, full disclosure, and the relationship that we just described? You know, coming back to especially this idea of consistency, comparability, and of course, this would be our disclosure principle right here. So these are the three concepts as they are related. So again, something you have to think about. Yeah, Matt? Okay, here's a good question. It depends on the type of change. Some changes require that, let's say you show 3 years of an income statement. Some types of changes, and this is where we step into more of an intermediate area, but to answer your question, because it's a very good one, if you change your method in 2013, but you're showing me 2012 and 2011, certain accounting changes say that you have to restate those prior years so that the 3 years are the same. Other changes, no, but that is the best way to do it if we can. So we go back and change the prior years as well so that it becomes easier to compare. Now, if we don't change the prior years, the good thing is you got the footnote, and the footnote would tell you that income is higher by 1,000. You could just subtract it and then compare it to the prior period. So either way, it could restore the comparability. All right, another concept, unless there are other questions. Another concept that we discussed is materiality. And essentially, and I said this several times in the first couple of lectures, if something is material or something's not material. Materiality is simply the significance. And what it's telling you is that a company has to follow GAAP very strictly unless the impact is not significant or not material. So if we tell you that you have to use, and now you know from the exam, you've got to use the accrual basis of accounting. You cannot use the cash basis. There's one of the questions on one of the exams. You can't use the cash basis. But if your business is such that you have very few cash transactions, you could account for some of those on a cash basis because it's not significant. So you could violate GAAP as long as the effect is not significant. Or material. Materiality means it would cause a judgment or cause a user to change their judgment, or would have an impact on the judgment of a user. So it's significant if it can influence somebody's decision making. And that's what we mean by materiality. Now, an example here, and this is absolutely true, where companies will just chop off zeros. You know, you could have a company like this, cash says, it looks like 7,500, but it's actually $7,500,000,000 because, sometimes it's insignificant. $7,000 wouldn't even show up sometimes on the financial statements because they put everything in thousands or hundreds of thousands or millions. So most corporations would show their financial statements in millions. So the materiality concept, to summarize, is best described as any event or transaction that is significant enough to influence the judgment of a reasonably informed user. That is the strict definition of materiality. It's any event, transaction, or result that would be significant enough to influence the judgment of a reasonably informed user. Yes? Can't hear. Okay, go ahead, try it again. Wait, could you hold it down so I really can't hear him? Again? Yes. Yeah, okay. Materiality is subjective. So for example, 7,500 is not material to Apple Computer, but it's material to me. Right. It is. It is subjective. It is based on professional judgment, and it is hopefully, in 99% of the cases, the right judgment. Yeah. I missed that. Right. Yeah. I mean, all right. So let me answer your question very simply. In accounting or any profession, law, even medicine, there's going to be some judgments that are used. And in some cases, by subjectivity, we mean that it's not going to have a clear-cut answer one way or another. Yeah. Yes. Okay, go ahead. We'll take this for one more minute, but then we can talk outside later if you want on this. Okay? Yeah. No, I mean, I know what you're saying, but it's difficult. It's difficult to explain at this level. With again, it's a judgment call. It's based on, do companies make mistakes? Yes. And when they do make mistakes, they are sanctioned if there are errors in their judgment. So I can tell you that. Okay. All right. Conservatism. And again, you notice, by the way, this is I'm glad you brought this up because you look at all the subjectivity that's in here in a way. Conservatism. This is another principle that says that you've got situations where you may have a choice, and when accountants or managers have choices between accounting methods, conservatism means you select the one that's least likely, again, I don't know for sure, but it's least likely to overstate assets and income. It doesn't mean you purposely understate income and assets, but it means that if you're making a choice, you would try to be as conservative as possible. So, for example, if you're not sure if an expenditure is going to have future benefits, so for instance, advertising. Do you know if advertising with 100% certainty is going to benefit your company? Is it going to increase sales? No. So how do we handle advertising? We expense it. Years ago, we used to call advertising an asset. We used to say, if I run one of these Super Bowl ads, a guy, falls out a window with a horse or some kind of crazy thing that they do, right, whatever it is, that ad is probably going to generate sales for maybe a year, maybe 2 years, maybe 3 years, we don't know, but since we're not sure, we expense it. So that's the conservative area here. We're trying to be safer, and we're trying to, if we're going to make a mistake, we're going to make a mistake on the lower income side than the higher income side. Now, doesn't mean we purposely understate assets and income. So here you can see that what we'll do, and if you look at the box in green, we don't anticipate gains, but we do provide for probable losses. So to give you an example, if you were involved in a lawsuit, if there was litigation, and there was evidence that you could probably win the lawsuit, we don't put those gains in our financial statements until what happens? You actually win. So we want to be sure that there's an actual result, that you actually win the lawsuit. However, if you're being sued and there's a good chance you're going to lose, we're going to put that in the financials. We would accrue those losses if it's likely, if it's very probable that you're going to lose. So conservatism, again, means that if you have a choice, you will select the one that is least likely to overstate net income and assets. And again, the other example I gave you is if you think about that advertising example, does the advertising have future benefit to you? And if it does, well, maybe it's an asset, but who's to say? who could judge whether or not that advertising will have benefit? Who's going to know if those sales would actually be created? Okay, now a couple of questions on these concepts. Okay. All right, first one is a company reports in its financial statements. These should be easy, so that it uses FIFO. You just saw this like 5 minutes ago. It's an example of the disclosure principle. Yes. What's that? Yeah, I know, that's fine. Yeah. Okay, thanks. And it should be easy. Okay. All right. All right. So, of course, that's the disclosure concept. Hopefully, I was hoping that would be 100%. All right. Let's try another one. I'm going to answer this next one for you. Company changes its inventory valuation method each period, which it could not do, but that violates consistency, and of course that is true. Changing one method to another will violate consistency. Okay? And another one. These should be pretty simple, I think. Well, maybe not. Let's ask this one. Company is uncertain whether a complex transaction should be recorded as an asset or an expense, so that from the standpoint of conservatism, it should treat it as an asset. Okay. All right, that's good. Of course, it should be treated as an expense if you're following conservatism. Again, conservatism by definition is trying to avoid overstating assets and income. Okay, last one. Last one. Okay, company discovers, and again, it is 219, so this one will take us right to 220. The company discovers that the cost of goods sold is understated by an insignificant amount. They do not need to correct the error because of materiality. This one should be, this is an attendance question, basically. All right. Yo. Give me a minute. It's 2:20 on the nose. Give me a second. Remember, I started late today due to technical difficulties. Okay. Yep. All right. So, yeah, I mean, this is materiality. By the way, the 29% here is a little too high for my taste. So make sure you cover those concepts. So we're in Chapter 6. Quiz 5 is within an hour and a half.